Good afternoon, everybody. Thanks for jumping on. You are in the right place if you're here to hear about today's real estate market investing. Don Wenner here. Lots of people jumping on, so I'm going to give it another minute or so before we kick off. But thanks for joining. Reminder: you can type questions in the Q&A box, and my colleagues here, Larry and Rich, will ask those questions as we move along here this afternoon. So again, thanks for jumping on. I'll give it about a minute and we will get started. Feel free to start typing any questions you may have now, and look forward to answering them and providing everybody some value here this afternoon. All right, everybody. So it is 4:00 Eastern. We will go ahead and get started. I know many are still joining, but I will respect all of your time and kick off here right on time. Today's I'll call our monthly segment now. We were doing, as many of you know, these every week for quite some time. We've now moved these in between some of our live events every 3 or 4 weeks. So it's been a little while since we've got together in this format. So excited to share some of the updates of what's happening here at DLP. In terms of us as an organization, in terms of acquisition, in terms of the real estate market, lending, our performance, and so forth. So we will dive in to all of that and more here over the next few minutes. A reminder to those who just jumped on, you can type any questions into that chat box on Zoom or if you're on social media. And my associates here, Rich and Larry, will ask those questions out loud here as we continue forward. So with that said, let's get rolling here. So first, I'm going to tell those of you who are new, and some of you, as I'm looking at the participant list here, definitely some names that I don't yet know. So there's some new folks here with us today. So I'll tell you a quick bit about DLP for those who are new. I'll keep it short for the benefit of those who know lots about us, and then we'll kind of dive in. So my name is Don Wenner. I'm the CEO and founder here at DLP Real Estate Capital, which is our parent business that oversees all these other companies you see on your screen. But our engine, what drives everything we do at DLP, is all of you, our investors, and DLP Capital Partners, which is our private investment fund management business, where we take in capital that lots of families entrust to us, and we deploy that capital into acquiring and managing and improving real estate, as well as lending capital to other investors who do the same. And then we do all the execution on those strategies, from servicing our own loans to doing the title work to handling the brokerage sales to managing and constructing and improving the properties that we own, including all 3 of the rental community brands that we run, which are Dream, Live, and Prosper, which is what DLP stands for. Dream are our kind of top level, kind of Class A type communities. Live are our workforce, most affordable housing, and Prosper is our generally pretty well amenitized sort of Class B communities as well. The key to our growth and everything you're going to hear and I'm going to show here over these next few minutes is our people. We have nearly 400 people now at DLP. I think probably by the time I talk with you guys again, I'll be telling you we have over 400 team members or employees here at DLP across our various businesses. Over 100 here in the state of Florida, where I'm talking to you from right now in St. Augustine, over 100 in our Pennsylvania headquarters, and another couple hundred throughout our real estate portfolio. We are a value and purpose-driven organization. You can see our 10 core values. I can say with extreme confidence that as you get to know us and talk with many of my colleagues, such as Rich and Larry here, if you went out to one of our communities and talked to one of our property managers, or you call up our office and talk to one of our receptionists, you're going to feel and see these values displayed throughout the people we have in our organization. And you're going to sense and feel this purpose through the intentionality of everything we do here at DLP. I want to thank many of you. We had about 200 in total of our investors and our operators that we lend to who joined us, I guess about 3 weeks ago now. in Ponte Vedra, about a half hour north of St. Augustine, where I'm talking to you from, for our Prosperity, Family, Wealth, and Legacy kickoff event. Pretty cool time. We had some great entertainment. We had some even better speakers, and best of all, some really great investors and guests who joined us and were incredibly engaged throughout the weekend. So thank you for that. I've been hearing lots of feedback from many. It was really a great time, and for me, as hopefully it was for all of you. With that said, that's going to be that event was our first ever of these types of events. We're going to do another one coming up. So if you missed it, you didn't miss out forever. It's another opportunity. And coming up here in March, we're going to be kicking off another Prosperity Weekend event in St. Simons Island, Georgia, as well as doing this inaugural gala also in Bethlehem, Pennsylvania. So we're actually going to, first time ever, we're going to host a live event in 2 locations at the same time. So we're going to be having some of us live from Bethlehem, some of us live from St. Simons Island. And we're going to be doing something a little different in that we're going to be doing a gala event focused not on our investment funds directly in any way, but focused on the DLP Positive Returns Foundation, which is focused on the crises of jobs and of affordable housing here in America and around the world. And so we're going to be doing some pretty cool things. I'll get into more as we get closer for this inaugural gala. And we'll be talking about how, though, all of you, and as you guys look here today at our investment funds and what we do, one of the coolest parts of our foundation is 0.25% of all the capital that any of you are investing with us is actually getting donated to the foundation out of our management fee from your investments. So whether you knew it or not, if you're investing with us, you're supporting the foundation, and love to be able to share with you more about what it is you're supporting and what we're focused on doing. And that'll be the kickoff event for a full weekend of a prosperity event like the one we did a few weeks ago, which again, we'll talk a lot more of over the weeks ahead. All right, so enough about us. Let's talk a little bit about what's happening in real estate. So multifamily real estate, and really at the same token, single family real estate has weathered, this starting point of really a recession in many ways better than any other real estate sectors, maybe other than industrial. Housing prices and rents continue to go up, largely due to really low inventory and really low interest rates and strong demand, both for sale and for rent across much of the United States, and certainly in the markets where we focus on. Rents have increased about 1% year over year. Yes, in this environment of heavy unemployment, rents have actually grown. In a lot of the markets we're in, they've actually grown closer to 3 or 4%. And then home prices in many markets around the country, such as Lehigh Valley, Pennsylvania, home prices have gone up 9% this year. Pretty amazing. Demand for affordable housing, again, both for purchase or for sale, as well as for rent, remains incredibly strong. Demand is high and supplies remain at all-time lows, and that's only continuing to contract through this COVID environment in terms of the available supply. So our performance throughout this environment has been something I'm pretty proud of, and pretty proud of because of the level of effort of our people across our portfolio. So our stabilized communities, most of our apartment communities, other than communities that are in ground up construction or in complete construction stage, are well over 94% occupancy. A large percentage of our communities are at 97, 98, 99% occupancy. We're doing a lot of unique things to continue to drive up that occupancy, including we just did our second ever national open house this past month, where we had 1,050 lease applications secured over just these past couple months, many of which just over one single weekend of this big open house event. We've had over 100 more move-ins than move-outs so far this quarter, about 120 additional move-ins and move-out, meaning our occupancy has continued to soar through this quarter from what was already all-time highs heading into this quarter. We've increased our rent by over $1 million annually just this quarter alone in our additional move-ins. We've been recognized for the great work that our team's been doing out in the communities by being named one of the top 40 workplaces in multifamily real estate just these last couple weeks, which was pretty cool acknowledgement for the effort our team is putting out each day to drive cash flow, to drive returns, and equally as important to keep our communities great, safe places for our residents to live. Some other COVID updates. So we've continued Across the country right now, data says across 11 million apartments that 93.6% of rent payments were made versus the same time last year, 95.2%. So about just under a 2% decline year over year. That's with the moratoriums not allowing eviction in many markets, in many states. So DLP, we've seen similar. We are certainly at much higher delinquency today than we were a year ago or we've been in the past due to these moratoriums. But all in all, our cash flow has continued to rise month over month since COVID, which is pretty cool. So what we expect to happen in 2021, we expect multifamily construction to remain very much depressed, very much limited, certainly not enough to keep up with the growing demand. The National Apartment Association says the U.S. needs 328,000 additional multifamily units over this decade alone just to keep up with the demand. That's just the multifamily segment alone. That means every year we're having a 30 to 40,000 unit additional undersupply annually. Pretty amazing. So in short, that means demand is going to remain very high, especially in the affordable sector, where our average rent across our portfolio is about $850 a month. The demand for $850 a month apartments across much of the United States has never been higher. CBRE, one of the leading authorities in the world of housing and real estate as a whole, has forecasted pre-COVID vacancy rates and a 6% increase in net effective rents in the next year. 6% rent increase this next year, and a full market recovery occurring in early 2022. So that's arguably, you could say it's aggressive expectations, but we're seeing this from a lot of quote unquote experts, economists, predicting a pretty bullish market here ahead, which is pretty astounding, showing the resilience of this sector. So some other things to expect here. I know a big question we get a lot here, myself and Larry and Rich, many of us, is are these government stimuluses going to continue? Is there going to be a second wave of the CARES Act? Obviously, we all are seeing and hearing the news as you are. Of course, none of us know for sure, but it does. We appear confident, many of the experts we talk to, that there will be another stimulus package, but it might not come out until ultimately and be passed until early 2021. We'll see how that affects things. If they continue the moratoriums, what they do in terms of the average resident versus the small business owner component. But it'll be interesting to see. We'll keep you guys posted as it becomes clear. But we think, regardless of exactly what the CARES Act does, there's positives that they continue these moratoriums and they provide a lot of additional liquidity out to the average Americans, such as the $1,200 checks and the additional unemployment benefits. That certainly helps us in one regard and hurts us in the other. If they do nothing and we can finally move residents out who can't pay, the demand for those who can pay is high. So either way, depending on what the government does, we're very confident in our ability to continue to navigate it and continue to perform well. So some of the things that are happening at DLP and some of the things that we'll be able to share with you here in the upcoming weeks, telling you what we expect to happen here at DLP, what we're going to accomplish this next year with your help. We are no doubts we're going to continue to dream, live, and prosper heading into 2021, marching our 20 miles. We grow our businesses, grow our organization, grow our number of team members, grow our family of investors. And we kick off each year at DLP with our Vision Day, which we're doing this year on January 15th, where we share with our internal team the exact direction, vision to the organization. We give out some cool awards. It's a really fun time. If anybody wants to see our 2020 Vision Day video, we'll be happy to send it over to you. After we do our Vision Day here on January 15th, we will also share that out with all of you, and it'll give you some clear understanding of us as an organization and what's ahead as well. So we're really excited and planning for that. Some of the recent acquisitions, for those of you who haven't been with us here or we haven't had a chance to connect here in the past month, I'll share some of the most recent acquisitions. Even more exciting, I'm going to share what we're about to acquire. I'll tell you a little bit more about how you can invest in what we're doing if interested in doing so. And then we're going to open it up here to questions. So our most recent acquisition is this community here in North Charleston, South Carolina, 353 units, called Pepper Tree Apartments. It's about to be rebranded, but right now it's called Pepper Tree Apartments. This is a community built between 1983 and 1989. We bought it with good occupancy, 97% occupancy, but with some great opportunities to grow rents, to improve the quality of the apartment. This is in a great area that's growing. Population is growing. Jobs are growing. Really, really strong market. Here's what the communities look like. Nice curb appeal, brick construction, some pretty good amenities. You can see the pool there. Nice units, good size, good diversification units. And we're basically coming in there and doing unit upgrades. On the left shows you what one of the previous owner wanted his unit upgrades with the updated cabinets and counters and black appliances from what they originally, the rest of the units look like on the right. So we're coming in there and improving the quality of these units, better appliances, lighting, cabinets, counters, etc., flooring, and expecting to drive rents up while still being incredibly affordable. Addition to improving the cosmetics of these apartments, one of the cool things we're doing is adding air conditioning. So crazy to say, this property is in Charleston, South Carolina, which gets quite hot, and there is no air conditioning. So we'll be addressing that. So pretty cool. We're going to put some great money into improving this community, make it a really, really desirable place to live. We invested about $10 million of equity. You can see here, $10.3 million. We're expecting very conservative, 18% annualized return on this investment. You can see here, average in-place rents, $843, almost our exact portfolio average. You see here over on the right, our IRR, our cash-on-cash returns on this deal. Really great property, really fits nicely in what we do. Great market, great area, good size asset. Really a good prototype of the types of investments we make. Coming up here, these are our newest deals that we put under contract here in Kentucky, Paducah and Owensboro, Kentucky. Our team has been out there all this week doing on-site due diligence. I was out there last week on due diligence. These are two communities, 240 and 320 units, built by the same developer. They look very similar. This is the one in Paducah, really nice community. This one was built, I believe, in 2014. You can see the quality of it being only 6 years old. Really nice amenities, really well kept, really well built community. Here's the one in Owensboro. Again, very similar, a little bit bigger, 320 units. But again, nice amenities from gyms to nice pool areas to big clubhouses to car wash to dog parks. Really, really nice community. So between these two communities, we'll be investing a hair under $20 million. And we're modeling these two deals out, again, using our conservative way we underwrite, to 23.9 and 20.4% IRRs, respectively. And you see here, again, interesting enough, average the rent in Paducah, $851 a month. Owensboro, $887. Again, right in line with where a lot of our apartments end up, which is we really focus on buying apartments, whether it's these communities built in 2014 and 16 or Charleston built in 1983 to 1989. We focus on affordability. We focus on our rents being affordable for the incomes that people are earning in that local market. That's the key at the end of the day to our business model, while being in markets with strong job growth, strong population growth, and limited new supply. So some stats on each of these deals, which we're very excited about. Another deal we have coming up, Myrtle Beach, South Carolina, 188 units built in 2000, doing some unit upgrades here, as well as bringing a number of units, about 30 units online that were actually damaged through a fire, unfortunately. It's a smaller deal, only about a $20 million total deal. But you can see, again, very strong returns, really great double-digit cash-on-cash return, 22% annual IRR. And again, $852 average in-place rents. So you can get a sense of the types of communities we're doing. This is built in 2000, kind of in the middle of these other deals we looked at. Again, similar affordability, similar strong, diverse markets, growing markets, strong job growth, et cetera. And then likely will turn out to be our next acquisitions are these four communities here we call the Gulf Coast portfolio: Gulfport, Mississippi, Orange Beach, Alabama, Jackson, Mississippi, and Senatobia, Mississippi. These are four communities we already manage. So we know them well. These have been our best performing portfolio through COVID. And really excited to take ownership of these, full ownership of these assets. So these are nice assets, largely built in the early 2000s. One community, the smallest one, less than 100 units, was built in 1989. The rest built late 90s to early 2000s. About 94% occupancy today. Our rents range from $866 to $970 a month across the portfolio. Nice communities. These are all branded Prosperous. These are kind of our middle line communities where the bulk of our communities are today. Really nice amenities. These were all built by the same developer, and really good construction. Really, really nice, nice assets. And we have phenomenal teams on these properties as well, which is what makes them really work and why these properties have performed so well. So all of those properties that I just showed you that we just bought or about to buy are all being purchased in the DLP Housing Fund. This is our $1 billion evergreen REIT. This is the 8th fund we've done in this past decade. This is our first ever evergreen equity REIT, meaning this is an open-ended fund that will continue to grow this fund as long as the strategy makes sense for us to do so. So even though we're going to run this fund for likely 10, 15, 20 years or longer, you as investors are going to have the ability to exit this fund each year. So you have to make no long-term commitment, have all the flexibility of exiting the fund when it's best for you, not when it's best for us as the manager. So this fund, again, evergreen open-ended REIT. That means it's very tax efficient, in short. This fund already owns $300+ million in real estate. We value that real estate every year, producing updated valuation to the portfolio. Again, as you an investor, you can redeem out each year. This fund is extremely tax efficient. Not only do you get the benefits of depreciation, which shelters most of our operating income from tax, defers that tax. In addition, by being a REIT, has the benefit of qualified business income deduction, which reduces each person's marginal tax bracket by 20%. But the other really unique benefit of this fund is that as we sell assets, we sell properties, we'll be able to exchange them into another property using 1031 like-kind exchange and deferring out our capital gains as well. So very, very tax efficient, as well as being very tax efficient and producing really great returns. The other nice benefit is we have the option of you taking monthly distributions. You can take distributions every month. So if this fund is of interest to you, highly recommend. We got a great volume of deals that we're acquiring right now. As I just showed you, we're going to be deploying a lot of money. Actually, we just deployed, I can excited to say, $15 million here of the housing fund's capital here just this week. So we're getting capital deployed. A lot of money is going to get deployed here quickly. But historically, it takes us, and this is really the only challenge any investors ever bring forward to Larry, Rich, or myself, is people wanting us to get our capital deployed quickly. And I always say jokingly, investors, we've spoiled investors a little bit in that they expect us to deploy their money, really, really fast. We've averaged between 6 and 30 days to fully deploy money, meaning from the day you sign up to invest with us, the day we have your money fully invested, fully earning the returns that the fund generates. But historically, we've been on the shorter side of this 6 to 90 day window. But that's, in the scheme of things, compared to most other investment funds, a very short amount of time. And of course, when we all think about it logically, you don't want us rushing to deploy money, rushing and buying deals is not a great deal, or taking any undue risk, especially say on our lending side, simply to deploy money, of course, right? You want us to make great sound decisions, do full underwriting, which requires thousands and thousands and thousands of hours on each deal. Check every box before we deploy and trust all of our capital into a new asset. When you look at most private equity firms out there, it can take up to 5 years, if not longer, to deploy your money. In many cases, your money never even gets fully deployed, even though you had to commit that money and be ready to fund it within a week or two, whenever the fund manager calls it. So we operate in this open-ended evergreen structure where when you sign up and invest, we're always taking capital and we're able to deploy your money in the scheme of things in a really, really short amount of time. We'll always do our best to give you some insight to what our expectations are, how quickly we'll deploy. But I can tell you confidently here in the housing fund, we have great volume, as you just saw, and we're going to be able to deploy capital in a pretty reasonably quick amount of time here in the months ahead, which is exciting, as we're going to have a pretty huge next 12 months on the acquisition front. This just shows you here, how long it takes based on how long it takes us to deploy your money, and what your returns are here in a DLP fund, what the losses would be of you waiting to deploy that money if it was sitting in a CD or money market account or even an index fund. Really what we're talking about, penny if your money's sitting cash or sitting in the S&P and S&P happens to be doing really well, we're talking about you losing $58 to a couple $1,000 at the highest case if it took us 90 days. That's a pretty small amount of loss, considering we're generating 12% plus returns annually. So with that said, we'll do our best to deploy everybody's capital quickly and generate phenomenal returns for you from there on out, as long as you want to be a part of the fund. As again, it's evergreen, open-ended. You'll be able to keep your capital earning and growing as long as you see fit. All right. Quick overview to this fund here again, 6% preferred returns. That means you earn 6% before we earn anything, including a management fee, meaning you get your 6% preferred return from the day you invested before we can even get a management fee. After we get our management fee, the fund continues to generate 80% of the profits to you, with a target of at least 12% returns net to investors each year, incredibly tax efficient, with the ability to redeem out each and every year. And last point I'll mention here on our housing fund that I think is important to mention, especially those of you who are new to us, is today we own right around $1 billion in real estate. Out of all the real estate we own, myself, my family, we own about 46 to 47% of all the real estate we own is our interest. And in this fund, we're required to invest at least 5% of the committed capital. Right now, we're somewhere around 25% of all the capital in the properties the DLP Housing Fund owns. So meaning we're investing heavily in these assets. We are our own largest investor. So there's a great alignment of interest in what we're buying and how we're executing on it. Again, what we're mainly buying is rental communities, mainly affordable workforce, and that they're affordable for people in that market, what they can actually afford. We're mainly in smaller markets, secondary and tertiary markets, mainly throughout the Sun Belt, the Southeast area. As you can see here on this map, these are all the apartment communities, rental communities we own today. Here's our historical growth. In 2017, we bought over 3,000 units. In 2018, we bought 4,200 units. Last year, over 3,000 units. And we're targeting between this year and next year to be over 14,000 units in total. This year, we'll see, depending on these acquisitions, if a couple of them land before the end of the year, where we'll end up, but likely somewhere between 3,000 to 4,000 this year, with pretty big plans heading into 2021, as you can see. Overall, we think this can be a great time to invest. We hit on some of these points earlier, but we believe the rentership in America is going to continue to grow. Rent, especially in the affordable sector, is going to continue to grow and be solid. Occupancy demand is going to remain very, very strong, even as we navigate through whatever the fallout, whatever the volatility of COVID, new tax policy, et cetera. So I feel very, very confident in our ability to continue to execute on this strategy, as well as on our lending strategy, lending on these same type of assets. Buying these types of deals, multifamily real estate, especially value add Class B, which a lot of people categorize what we do as, is the number one most desired asset class today out of any real estate asset class, if not any asset class. There's more money trying to invest in multifamily real estate today than any other asset class. And there's good reason for that. Everything I've just covered here is good reason for that. But what really helps us to generate above market level returns comes down to a couple of things. One is certainly our ability to execute, but two, the disciplined approach we take to buying. If we went out there and just bought properties at top dollar, like a lot of the large Wall Street institutions do, we wouldn't be able to generate the level of cash on cash returns, let alone the overall IRRs we generate. It takes a lot of effort to find and extract, as well as create value across our portfolios we do today. So I'm going to move here a little quick due to time. And hit on the last couple of things here related to that. So this gives you this little funnel here, which we've been showing for a little while now, gives you a little insight to kind of our pipeline. So every month we have 300 to 500 deals coming to us from banks, from auctions, from brokers, directly from owners, from our own sales team. We have hundreds and hundreds of deals coming in. We take those deals, we narrow them down to 40 to 50 deals that we underwrite, meaning we go through, we review the financials, the rent rolls, the balance sheet, the trailing financials, the income statements. We evaluate the local market, we evaluate the competition, we do a full underwriting model on that deal. Out of those 40 to 50 properties that we spend a significant amount of time underwriting, many cases getting out to physically getting a feel for them, we take 10 to 30 of them that we then go and do full due diligence, involving traveling to the community, to the competition, really diving deep, talking to management companies, diving deep with the local municipality, understanding crime, getting a deep understanding to the asset, the market, et cetera. And then out of those deals, 5 to 20 deals a month at least, we're putting offers out on, getting into negotiation on. of which only 2 or 3 times a month do we actually get our offer accepted, because usually there's somebody willing to pay more than we are. And 1 or 2 deals that get all the way through then the real due diligence process, spending hundreds and hundreds of hours on site, going through every single apartment, getting engineers out there, doing environmental studies, getting valuations, appraisals done, getting contractors out there, you name it, that get all the way to the point that we buy them. About 1 deal a month that we end up buying out of this enormous pipeline that's literally taking tens of thousands of hours of many people's times each and every month. And that's only the starting point. Then we got a deal that works. Then it's about going in there and adding real value. Most of the deals that we buy require us to do significant capital improvements, parking lots, roofs, upgrading and improving apartments, adding amenities, certainly improving management in many cases, improving the resident experience, in turn, driving rents, improving occupancy, reducing maintenance costs, and increasing our retention of our residents. This discipline buying, comes out to look a lot like what you see on the screen here in many cases. Generally, we're underwriting and achieving at least a 7% cap rate at our cost. Generally, that turns out to be, with today's interest rates, double-digit cash flow. We're assuming very conservative expectations to the rent's going to grow by 2% a year, expenses will grow by 2% a year, that the investment market's going to soften, meaning that properties will sell at much lower cap or higher cap rates, lower prices when it's time to sell. We use very conservative analysis to end up that most of our deals underwrite to at least a 20% annual IRR and double-digit cash-on-cash returns. We put on long-term non-recourse debt. Much of the debt we're placing across our portfolio today is in the low 2% interest rate, fixed for 35 years, non-recourse. Pretty amazing. We do a lot of analysis. You see some more of that detail here to get to the point that a deal works for us, that we actually move forward, acquire it, and then set up on executing our business plan. So that most of everything I covered here, I'm going to spend just the last minute or two here before I open up to questions. Everything I just gave you details on is what we do on the equity side of our business, everything that we do through the DLP Housing Fund side of our business, which is where right now we're experiencing tremendous growth and also have the biggest opportunity for investment. And I feel, with all the factors heading into 2021, a phenomenal place to be, especially with the concerns I know many have to taxes increasing. The housing fund is one of the most tax efficient places you could invest, which again, I believe is going to become even more important over these next at least 4 years. So the other side of our business, though, is the lending side of our business. We're lending money, short-term loans, to real estate investors, similar to DLP, investors who are buying single-family homes, buying apartment communities, building single-family homes, or we're giving them money to acquire and improve these assets. This fund here, the DLP Lending Fund, is our largest lending fund strategy. This is a mortgage pool REIT fund. We've been running this strategy for 6 years. These are all first position mortgages at an average of 54% loan to value. In short, we distribute double-digit returns with 2 distributions every month in great liquidity, 90-day redemption. We've generated over double-digit returns every single month since this fund launched, with 2 distributions every month in great liquidity. Lastly, here's our overall performance since we launched the fund. Really great, consistent double-digit returns. The last option, a way to invest with us, is actually lending money to our lending strategy. And you can do so and become a positive note fund investor, a note investor, where you're locking in for a fixed return on your investment, kind of similar to a bond investment, except much higher returns than today's bonds, where you can lock in anywhere from 5 to 10% based on how much you invest and whether you want to commit just for 90 days or as long as 5 years. You get a corresponding fixed rate. These returns assume you're taking distributions every single month, but you actually have the option of compounding those returns and getting the power of compounding returns and getting even higher annual yields by compounding the interest each and every month. So if interested in anything we talked about here, certainly we're going to open it up right now for questions. You'll be able to ask any questions you have, or I should say open up for questions in just a minute. But in addition, you can follow up with any of my associates here, Rich, Larry, Bob, Brett, or Mike, whoever you've already been working with. Reach out to them. If you're not working with anybody yet, pick the most handsome gentleman you see on that screen and reach out to them and get them to connect with you and help you evaluate further what we do and how it could fit with what you're doing and what your goals are for your investments. All right. So last couple of things I'll share is a couple of the upcoming events we have ahead. So Thursday, January 21st, which sounds like, at least to me, sounds like forever from now, but Believe it or not, I promise you, I checked the calendar. Christmas is in 2 weeks. The New Year is in 3 weeks. So the 21st, just a few weeks ahead, we have a virtual event. It'll be kind of quite a bit bigger, and gonna be some pretty cool things compared to this webinar. It's gonna be a big virtual event Thursday, January 21st. If you made it to this webinar, you're on our email list, I assume, and we'll be communicating a lot more information with you on this upcoming virtual event. In addition, we do these types of webinars at least every month at 4 o'clock. So welcome you to join these. We'll be sharing out our upcoming 2021 webinar event schedule as well. You can always watch them here on Zoom, as many are, or as well as Facebook Live, as I know many of you are as well. And if you're not registered, not sure if you're registered, you can go to dlpcapitalpartners.com. And on the homepage, register, make sure you're getting access to all of our information, news, and updates. All right, so I think that's everything I have here. I'm going to open the mic up here to Rich and Larry to ask any and all questions that you guys have brought forward.
All right, excellent. Well, thank you very much, everyone. We've got a bunch of questions, so we're going to try to get through these here in the next 25 minutes. So I'm going to start with a few that have come through in the chat box, and then Larry, I see we've got a bunch more in the Q&A if you want to answer those. So I'll start with Greg. The question is, how are you as a company going to deal with the foreclosures and evictions that I've been reading about? And what's supposed to be coming this January?
Yeah, it's a great question. I think there's, I'll cover that in 2 parts: foreclosures and then I'll cover delinquencies or evictions. So when it comes to foreclosures, I don't think I mentioned this, but in our lending strategy, so we are a lender, right? We make loans, mortgages to real estate investors. And since COVID, 9 months now, we have not had a single default, not one. No forbearance agreements, 0 on our entire real estate loan portfolio. So we've had phenomenal performance. So we're not dealing with foreclosures. We're not dealing with defaults and issues. And I think certain market segments, such as hospitality, as an example, which actually done better, I think, than most people thought it was going to do. There's certainly some segments in the market that are dealing with some challenges, and there are some defaults, and going to be some foreclosures in some different segments. So it'll be interesting. It'll create some investment opportunities from the optimistic standpoint, and then from the the kind of challenging standpoint of the economy. One of the nice things to think about, or that I remind myself of, is coming back in 2006. Really 2006 was the peak of the market, but 2008, 2009, as people think about it, in the big, great recession and all the foreclosures that happened then. It was a very different environment than today, in that the real estate market was very soft and property values were on the decline. We had the greatest oversupply of real estate we've ever had, of homes we've ever had. Today, we have the greatest undersupply of homes we ever have. Pricing is soaring up. So why that's important is, if somebody is in foreclosure, somebody can't make their mortgage payments, the vast majority of the case, they can turn around and sell that home and sell it for more than they paid for it and walk away with money in their pocket. So it's not quite as desperate of a situation if you lose your job or don't have income today, as there's some great opportunities to be able to sell your home and actually walk away with cash. Actually, literally this week, we're launching a program at DLP Realty officially, where we buy people's homes right now for cash as is, and we're rolling out official programs right now where we're giving the people option to then lease that home back from us and even buy the home back from us. So it's creating some unique solutions that somebody, hey, maybe they need the equity out of their home today because they're out of work or whatnot, but they don't want to move. They don't want to uproot their family. And we give them the ability to lease the home back. And then down the road, they get a job and they decide they want to stay in the market or want to stay in the home, they can buy it back from us later. So that's a cool kind of thing we're doing on a small scale that's unique and helping in some of these unique situations people are in due to the unemployment. In terms of the delinquency side, I think what's also great is this is a unique time that delinquency is certainly higher today than it normally is. As you saw those stats earlier, about 1.6, 1.8% higher than it was year over year, according to data. But some of that delinquency is by choice. So some people are choosing not to pay because landlords can't do anything about it. The demand for at least the housing we own, affordable housing we own, there's way more people looking to rent our apartments who have jobs and can afford to pay the rent than there are apartments available. So the demand, the ability to replace tenants is great. And we're very confident as residents move out who might not be able to pay, might have to move in with family or some other situation, that we'll be able to replace those residents with new paying tenants who have stable jobs. So hopefully that answered the question. If I didn't cover any part of it, feel free to retype it in, and happy to answer it.
Sure. No, that's perfect. And in fact, I think you answered part of the next question, but I'm going to ask it for the benefit of those on the phone. So, Stephanie asks, what are the impacts of the 9% increase in housing price in Lehigh Valley? And with low interest rates, do you see people leaving the leasing market and going into home ownership?
It's a great question. A great question. So number one, the nice thing is one of the reasons home pricing can go up 9% and still be, great demand is as you commented there, follow on there, is that interest rates are so low. So right now, the average monthly mortgage cost today, even with the increase in pricing, is less than what you would have paid for the same home a year ago or 2 years ago or 3 years ago. Even though the price would have been lower, the mortgage rate would have been higher, still low, but higher than it is today, which means in effect, the monthly payment, which is how most people base the mortgage on and the home price on, is what they can afford each month, is actually lower because of the incredible interest rates today. In terms of the question of, are we seeing people leave renting to go back to home ownership or to become homeowners? So as a market whole, the answer is no. It's a net outflow of people from home ownership to rentership. There's still a movement of people from home ownership to rentership, and I don't think that's going to change. If anything could change it, it would be exactly this question, that right now it's arguably in certain cases cheaper to own than to rent from a monthly basis. So that's a pretty big motivator to consider home ownership. But I think with a lot of the volatility we have today in jobs and just life right now, more and more people need and want the flexibility of rentership. And it makes the best sense for a lot of people. So as a whole, no, we're not seeing that. We have had some pockets in our portfolio. As an example, we have a community in Wexford, West Virginia, Scotts Depot, West Virginia, I'm sorry, called Dream Wexford, that we did deal with 25 residents who left the community to become homeowners. So that was probably the only community we dealt with that as a reoccurring situation. But we're at all-time high occupancies in that property despite that. So it is happening in certain cases, but as a whole, people are continuing to move towards rentership.
Awesome. Thanks, Don. So we have a couple of questions here along the lines of the fund specifically. So as a preface, this is a prospective investor. It says, I believe multifamily to be a great market, but I'm concerned about concentration risk. So as a prospective investor, would you suggest either the housing or lending fund or splitting? And what would you consider to be the biggest risks to consider for someone versus stocks and bonds, of course, which have done pretty well over the past couple of years?
All right. Thank you, Larry. So those were quite a few questions, I think, in one. So first, question about concentration. So one of the nice things of investing in the DLP Housing Fund as an example versus investing in a individual apartment community is concentration. So you'll see not only is your investment not located in one property, it's not located in one market or one state or in one region even, as we have great diversification to our portfolio. 5,000 plus units owned in the housing fund right now across 10 plus states. A year from now, it'll likely be 10,000 plus units across 15 or more states. So great diversification, which creates consistency in returns and cash flow, diversification from any risk, whether that be weather related, whether that be employment related, et cetera. In terms of, would it make sense to diversify between lending fund or housing fund? We have many investors. A lot of our investors are invested in 2 or 3 of our funds. So that's very common that people split the investment. If the investment is not, haven't spoken about this. If your capital is non-qualified, it's cash, it's not retirement money. I mean, it's not IRA or 401k money. The housing fund is extra attractive because of the incredible tax efficiency compared to almost any other investment. If it's qualified money, that can be that kind of diminishes the additional value of being in the housing fund over our lending fund. even though the returns will still be higher in the housing fund, most likely. You get the great tax efficiency or tax shelter of being in a retirement account that kind of takes away the tax benefits for qualified money. But in short, many people invest in both. Some people put, common situations, people put their qualified money in the lending fund and their non-qualified or cash money in the housing fund. We can help you evaluate that based on your goals, based on the horizon of your investment, based on your desire for liquidity, your desire for consistent monthly distributions, which can make the best sense. I think the last part of the question was, what I think the risks are, and I think how do I compare that risk to, public markets. So, I think the biggest risks in a doomsday scenario, as I think about whether it's really the housing fund or the lending fund or any of our funds, really is I feel extremely confident, regardless of what happens with investor markets, regardless of what happens with the overall economy, that we're going to be able to generate good cash flow in the lending fund or the housing fund or any of our funds, regardless of kind of the volatility and what's around us. I think the challenge becomes there's a doomsday situation and property values drop a ton and real estate becomes illiquid. None of these things that I'm expecting to happen in the near term, but many of those things do happen. Then liquidity gets harder. It gets harder to provide liquidity. But frankly, if market values are down and the market's terrible, you probably don't want to redeem your investment, especially an investment that's producing great monthly income to you. I'd say that's the biggest concern in a really recessionary environment is liquidity. But our ability to protect capital, generate consistent monthly returns, very, very, very confident regardless of the real estate market.
Awesome. Thanks, Don. So one more question kind of on the housing fund side specifically. How can an investor know how much appreciation there was during any given year, and particularly here in 2020, in addition to the 6%? And will there be an adjustment to the share price to reflect this?
Thank you. Yeah, so we go through our portfolio in the housing fund every year, and we get all the properties revalued by generally, and there's a couple of cases where there could be an exception, but generally through third-party appraisals by top appraisers at firms like CBRE and Cushman Wakefield and so forth. So we get all the properties reevaluated, and then we take those values, and that creates, along with the outstanding cash and so forth that we have, we come up with our overall value of the fund and what the overall increase is to the value of each share, the overall appreciation of each share. So that process is fully in swing, being finalized right now here. And by early in 2021, we'll be producing in the kind of year-end financials the updated portfolio-wide valuation and the updated share price, which will result in additional shares being distributed to each member of the housing fund for the proportionate amount of the increase in value of the fund. So yes, that all is in process. Yes, there will be an increase in overall valuation produced for everybody, and we are expecting to see solid increase in our portfolio value here in 2020, and be able to distribute that value out to our investors here at a year end.
Excellent. Thanks, Don. So with that, a couple more questions here on the housing fund. First is a pretty simple and straightforward one, which is, are there any expenses or administrative costs other than the 1.5% management fee and the stated share of profits?
In short, I'll say in short, not really. So the main other expenses behind the management fee are we have to pay for the audit for the fund each year. So tax cost of audit and tax prep. And then we do have the cost of the appraisals of evaluating the value of the real estate each year. That's pretty much it. So that's not income that comes to DLP. That's expenses for the valuation and tax work of the fund each year.
Great. Thanks again. And again, it is pretty transparent, and you can see that on our financial statements, pretty straightforward, no other expenses on there. Another housing fund question that came in is, can you describe how any depreciation would be recaptured from the investors in the fund when a property gets sold?
Yeah. Thank you. So when a property gets sold, we anticipate doing, at least in most cases, doing like kind exchanges, 1031 like kind exchanges. We're actually able to sell an asset and then transfer those proceeds to another asset and defer out any gains and avoid any recapture depreciation, at that point in time. When you as an investor will have a recapture to your depreciation, and when you're going to have to pay your capital gains is when you exit the fund. So really the taxable events are not when we sell a property, it's at the investor level. When you choose to exit the fund, that's when you'll have your taxable gain, when you'll have your capital gains, which will include some recapture to your proportionate share of the depreciation.
Awesome. Thanks, Don. So we have a question as far as the lending fund side from Derek. Do you believe there's an optimal fund size of AUM for the lending fund? And if so, what is that optimal size?
So I'd say the optimal size of the lending fund is the amount of loans that we can originate. So that's a very indirect answer to say that we feel very confident in our ability to continue to grow this fund and manage this fund. Right now, I'll call it a constriction, but it's not a long-term constriction as we continue to grow our loan size, our portfolio size, our loan origination. But as long as we're able to continue to originate good loans to high quality borrowers at a pace to deploy not only the new capital coming in, but be able to redeploy the capital that comes in as these loans pay off so fast. That's going to make sense for us to grow. As we grow this fund, it becomes more and more efficient. This is one of the most efficient, in my opinion, one of the most efficient businesses to run. And that as we get bigger, it actually becomes more efficient in many ways, and it allows us to get even better in every regard, from underwriting to asset management to processing to every regard, from the legal side. So just an example, just this past Monday, due to our growth, we were able to hire 8 new analysts in lending to continue to help us continue to do a great job, which we've proven out through 9 straight months of no defaults, but continue to, as we grow, be able to continue to mitigate risk and underwrite our loans and borrowers as well, as we've historically done, even as we continue to grow. So that's common to make there. This is an enormous industry. Just the single family fix and flip side is, depending on where you look in data, anywhere from a $20 to a $40 billion a year industry. The multifamily bridge side that we also lend on is even bigger. The new home building side that we lend on is even bigger. So there's probably in the neighborhood of 100 to 200 billion a year in lending in this space, similar to what we do. So, we're a very small percentage of that market still today. And if we were running $1 billion fund, we would still be, reasonably small, only a few percentage points of the entire market size. So we feel very confident in our ability to steadily, consistently, grow the fund and grow our originations, grow our team.
Awesome. Thank you, Don. So just a couple more questions here before we run out of time. Kevin had asked, is waiting for the evaluation of property values at the end of the year one of the reasons investors have to wait for deployment, or how does the deployment process work in general when it comes to new funds?
Yeah, great question. No, so the annual valuation has no bearing or no involvement in deployment. Our ability to deploy capital simply has to do with our ability to put the money to work. So in the housing fund specifically, the vast majority of the investments we make are that of acquiring apartment communities, rental communities. So example, if you were to invest in the housing fund today for whatever amount of money, if we're not buying an apartment community today, there's nothing I can, I'm being a little bit general, but there's nothing I can do with your capital yet today. So let's say you invested today, but the next acquisition isn't until December 30th. In most cases, we're not going to be able to deploy your money then until we acquire that next community on December 30th, when we have a place to deploy that equity. We have a property to acquire and put your money to work. So that's what drives the deployment is our acquisition pipeline, and as acquiring properties and deploying the money for the acquisition, and then in turn the improvement of that community.
Thanks, Don. All right, one more question, but certainly a popular and common one. Could you give us a status on the 2X portfolio? And I guess a part two to that is there interest in, because of the size of that potential acquisition, is there interest in bringing institutional money into the future?
Yeah, thank you. So the 2X portfolio is a large real estate portfolio of about 12,000 apartments that we presented and discussed here with you guys. I guess probably about 3 months ago now. So in short, the deal is still out there. We're still working on it. We've spent many thousands and thousands of hours working on this deal. We've been out to all 43 of the apartment communities, in most cases multiple times. We would really like to do the deal at the right structure and with the appropriate ability to mitigate risk through the transaction. So today I'll tell you it's 50-50 chance that we're able to get it done. Tomorrow I might tell you 80%, or I might tell you 20%. It kind of changes day by day as we have I'll call difficult sellers. But I'm hopeful. But also, as you can tell, we're not sitting around putting all our eggs in that deal happening. We're working really hard and building and growing our portfolio, as we always have through individual properties and or even in 2 or 4 community acquisitions, as we went over just a little bit ago. We also are working on some other very large portfolio acquisitions as well, and we do expect here. I'd be very surprised in the next year or so if we don't acquire a good sized portfolio similar to the 2X portfolio. In terms of would we bring in an institutional investor? So yeah, if we were to get the 2X portfolio under agreement, under the timetable we need to close, where that was going to be about a $300 million equity check. Yes, our expectation there is that we would bring in some level of an institutional partner simply due to the amount of equity and the amount of time we would have to place that equity. So we would have myself and the DLP Housing Fund invest a very significant amount of the equity, but we would likely bring in an equity partner to partner up with us from a capital standpoint on a deal like that.
Fantastic. All righty. So just for the sake of all our attendees today, we have one last question that we're going to wrap up with, and that's the simple one, which is, can you invest using a Schwab or Fidelity platform in any of the funds?
Yep. So you can invest, I mentioned briefly earlier, you can invest qualified and non-qualified money. We can take in qualified money through, self-directed IRA custodians, as well as we can take qualified or non-qualified money through Schwab, through Fidelity, and through other institutional custodial platforms. We manage hundreds and hundreds of accounts in that way, and can certainly do so. So thank you, Rich. Thank you, Larry. Appreciate everybody for the great interaction, great questions. Feel free to please follow up with any of my great associates here. Their contact info is here with any additional questions that we didn't get to here today, and look forward to talking with you guys and hopefully see many of you face to face in the weeks and months ahead. If I don't talk to you, Merry Christmas, Happy New Year. And appreciate all your support that you've shown to us over the year and years in many of your cases. So thank you.
Thank you all.